Good evening, everyone. A nasty and dramatic sell-off on Wall Street today with a rare triple-digit loss on the Nasdaq. Red was the color of the day, with all 10 S&P sectors down sharply. Here are the sobering numbers. The Dow tumbled 267 points. The Nasdaq plunged 130 points. That's a 3% drop and its worst day since November of 2011. And the S&P stumbled 39 points. That's a 2% slide. One big reason for the Nasdaq decline, more selling in biotech stocks. Take a look at the biotech ETF plummeting more than 5.5% today. So what happened? Surprisingly, traders and market pros were stumped. Usually they blame a steep slide on an economic report, a global crisis, or even the weather. But there was no one real culprit today. In fact, there were some encouraging news on the economy, with upbeat reports on jobless claims and home disclosures falling to 7-year lows. We have two reports tonight looking at the market action from the New York Stock Exchange and the hard-hit Nasdaq. We begin with Sheila Dharmarajan at the Nasdaq.
Today's action is quite the reversal from the two-day rally we saw earlier in the week and more than wiped out those gains. Getting hit the hardest are the biotech stocks. Nasdaq Biotech Index down nearly 6% on the day. And also high-flying so-called momentum stocks. Now, these are stocks that consistently move in a direction regardless of news. Now, that direction is down with names like Tesla, Micron, Priceline, Netflix, declining more than 3% today. As for the why, there's no particular reason that can be blamed. After all, the economic reports have been somewhat strong, and earnings season isn't quite in full swing yet. So traders I speak to say there's simply a shift in momentum, and investors are taking profits. Keep in mind that the Nasdaq did rise more than 35% in 2013. Now, as for whether the sell-off will continue, earnings season, which kicks off with the big banks tomorrow, will be the next catalyst for a move in either direction. For Nightly Business Report, I'm Sheila Dharmarajan at the Nasdaq market site.
After big gains yesterday, it was an ugly day for the markets. Healthcare, tech, consumer discretionary, and financials were among the biggest downside sectors. It's a confusing moment for the markets because it's not clear where the economy is going. The bears are arguing it's hard to force the markets higher without clear evidence the economy is improving. Today, they held the upper hand as traders sold stocks and bought bonds. But the bulls have been arguing that the economy is improving, but we are not going to blast off in the month of April. There is a gradual recovery, and there is no reason to pay a lot of money for overpriced growth stocks like Pandora or Tesla or Yelp if the economy is improving, because you could get modest growth cheaper by buying old school names like IBM or Caterpillar or even Microsoft, all of which have had modest gains this year. So who's right? Well, we will get greater clarity when companies begin reporting in earnest tomorrow and begin offering guidance for their current quarter, like Wells Fargo. Here's one canary in the coal mine to watch. There are 8 IPOs that are scheduled to begin trading tomorrow, including restaurateur Zoe's Kitchen. It wouldn't be a big surprise to see one or more of them postponed due to poor market conditions. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And joining us now to talk more about today's market sell-off is Jim Paulson, Chief Investment Strategist at Wells Capital Management. Mr. Paulson, welcome. Good to have you with us. Should any one of us be surprised that the market is selling off, most especially Nasdaq, where the price-to-earnings ratio is something like 35 times?
No, I don't think so, really, Tyler. I mean, it's been a long time since we've had, what, a 2% decline in the S&P or 3% decline in the Nasdaq. And I think that's what the market does every now and then, just make sure our hearts are working for us investors. But yeah, I think we've had a big valuation correction in one small part of the marketplace, the biotech, momentum, high-flying story stocks. Maybe that's not all a bad thing longer term for investors, but in the short term, it's been very sharp and very eye-catching.
All right, so we've been having this zigzag kind of trading for a while now, Jim, but I mean, is there something else going on? Is this going to be that correction that so many market strategists have been talking about?
One never knows, Susie, and I certainly don't either, and it certainly could continue on. There wasn't a big show of any bottom tonight, but my guess is it's more of an opportunity here than the start of a 10% or more correction, primarily because the underlying economic reports here remain very favorable. They continue to surpass expectations. This morning's report on unemployment claims was another report that was better than people thought, suggesting the economic momentum is very good. If that stays in place, then I think greed will return to this market, and more people will start looking at lower values and start stepping up again, pushing the market higher. So I don't know if it goes much lower. I think if we do have a correction this year, it'll be from higher levels than we have right now.
Let's bring in Joe Duran, CEO at United Capital Advisors. Joe, welcome. Jim Paulson just made the point that for the most part, the selling has been concentrated in what we describe as the momentum names, the stocks that go up because they've been going up, basically. Biotechnology, small caps, technology. But today, certainly, and in recent days, there has been some bleed through to the Dow stocks and to the blue chips in the S&P 500. How vulnerable is this market? And is this a time to buy the companies that have been on your buy list and you've been waiting for them to come down?
I think that the market is vulnerable. What I look at are two things for me that tell signs of when you should be stepping in safely. We are very optimistic in the long term, but there are times which you want to be careful. And right now, there are two things that concern me. The first one, most importantly, is we had a pretty big down day today. We've had a couple of them, and the VIX, the measure of fear, is really not reacting the way you would expect given an almost 300-point drop. So we were only up a couple of points today to 16. And you want to see that approaching 20 as a relatively safe entry point if you're in a big decline. The second thing that concerns me, frankly, more in a long-term sense, is what's been happening with the bond market. When you have interest rates flattening out, that's telling you that the bond market thinks that the economy is not doing as well as we all think. And a lot of us who are optimistic have been hoping for a significant pickup in the economy in the second half. I'm not sure we're going to get that. And the bond market tends to be more right than the stock market. So I'm a little bit concerned with that as well. And I think, as I mentioned in your show a couple of days ago, I was nervous that things are not looking the way I would expect if we're really, in fact, in the middle of a continuation of what has been an amazing move.
So if you're nervous, Joe, and you're saying it's a little bit risky to be buying stocks, even though they're buying opportunities, is it risky to hold on to stocks that have been doing well, you still like them, the fundamentals haven't changed, but you see big sell-offs on them? And I'm looking at companies, whether it's Google or Facebook or Netflix, that today we're down by 4% or more. Is it too risky to hold on to these?
No, I think the first thing that everyone should do is make sure that their overall allocation is right. We talked about this at the end of last year. When you have a big 30% move in stocks and the bond market is negative, your ability to have an allocation that's far more aggressive than you should have is very easy. And the market is still relatively flat for the year, so we should hold it in context. It's been disappointing because we started the year off quite well. But the thing to hold in context is to say, we're still doing fine. Look at your overall allocation and don't make any abrupt moves. Now, there are a lot of day traders who I can't advise, but long-term, you want to be careful.
Jim, respond to what Joe just said.
Yeah, I think, Joe's looking at bond yields that have come down, but really bond yields have been in the same range now since last summer. I don't know if there's any strong message there. What I'm attracted to is some of the messages coming out of the equity market in this pullback, Tyler. Look at the relative price performance within the inter-term makeup of the market here. The emerging market stocks are doing phenomenal on a relative basis. They're now outperforming the U.S. stock market year to date. Within the United States, the industrials are holding up well, the transports are holding up well, the basic material stocks are holding up well. In other words, the most cyclical areas of the economy are doing very well through this pullback, which tells me this is more about a short-term valuation adjustment in one small part of the market. The broader part of the market still is showing signs of improvement in the economy. And I think, if anything, we're doing good things with this. We're bringing down rates, bringing down the hurdle for stocks. Right. We're creating a little fear, which is causing people to raise some cash. That's new buying power for the future. And we're cheapening stocks overall. And I think we're setting ourselves up for another rally to higher highs before this year's out. So I look at this more as a buying opportunity rather than something that you should run from.
And Joe sees it the other way, and there
I
is
agree
how
a little. Sorry.
we have to leave it. I'm sorry, Joe, very much, but that's how a market is made. Jim sees it one way, Joe a little more cautiously, and he says we're not afraid enough yet. But at any rate, thank you, gentlemen. Jim Paulson, Wells Capital Management, Joe Duran of United Capital Financial Advisors.